Hey friends, this video you're about to watch is something that I recorded a few years back, and it's all about options. I'll talk about the options basics. We'll also talk about the Greeks, as well as some of the primary option strategies that one might come across in their trading. So I hope you enjoy it. Let me know below with your comments, and then we'll see you next video. Options are a contract. They are a contract between a buyer and a seller. A seller is sometimes called a writer. All right. And there are really two main types of option contracts. There's those kind of contracts called calls that give the buyer the right to buy stock above a certain strike price by a certain expiration. Now, like all contracts, option contracts basically have some criteria, and that's where we're going to get into the different types, the call or the put. And then they have a length to that contract, some time when the contract expires. So it's just like any other legally binding contract. The other type of contract is the put, and that's where you buy that contract at a certain strike price, and it gives the buyer the right to sell stock at that price. Now, of course, if the stock doesn't go below that strike price, it doesn't make a whole lot of sense to exercise the contract, or if it's a call and the stock doesn't go above the strike price, and it doesn't give a whole lot of sense to exercise that contract either. So but that buyer has the perfect right to exercise that contract at any time. Now, that's very important. That's one thing a lot of people don't realize that are buying and selling option contracts, creating spreads, and all this other stuff, that when you're a seller of a contract, you are obliged to do whatever the buyer decides to do. If the buyer decides to exercise, even if it's at a loss, unfortunately, you have to do what they do. I mean, it would be stupid for them to do that, but they do have that right. So just so you know, this isn't something where, you can have the full confidence that you can hold that option forever as a writer and never have to worry about it getting exercised. Now that's sort of the theoretical part of it. The reality is that in the vast majority of cases, you don't have to worry about getting exercised if you're a writer of an option until you get to or near option the expiration date, or if it's extremely deep in the money. All right, so. Now, as I said, there are two different types of options, and there's buyers and sellers. Buyers have rights and sellers have obligations. There's calls or puts. There's also, now I didn't mention this, but options represent stock, the underlying stock, or some underlying asset. Let's say it's Apple, okay? And that one option contract represents 100 shares of Apple. Now, with Apple's one of the few stocks that also comes in a mini version. And that's so that smaller players can participate in these big price stocks. And the mini version of the option actually only represents 10 shares. Now, one of the caveats of that is that the mini isn't as widely traded, although it's starting to pick up in popularity, so it doesn't have as much volume and liquidity in it. So just so you know. But the mini acts just like the regular full-size option contract that controls 100 shares. All right. So as I said, they have the underlying asset, they have the strike price, and then they have the expiration. Now, there's another part where there may be some differentiation. Most options traditionally had a monthly expiration that expired on the third Friday of each month. Now a lot of stocks have weekly options, and they expire virtually every Friday. And Apple, of course, is one of those stocks that also has weeklies. So Apple has the full gamut of option types. It has the minis, it has the fulls, it has monthlies, and it has the weeklies. So, and the great part about it is that almost all of them have incredible volume and liquidity, and nice tight bid and ask spreads. So, and that's really one of the reasons why Apple's such a great thing to trade, because it has all these options to you, plus it has all the volatility and all that other cool stuff. So back to options. Now, options are openly traded, and they can be exercised at any time or held to expiration. They can be either settled with cash or the assignment of stock. Now that's an important point, especially if you're a a seller. You have to be very careful about whether or not you're going to be assigned stock. And most options traders, especially those that sell options, and we are going to be really a net seller of options so that we can collect the premium. I mean, the purpose of being the seller is so that you give someone else the right to do something, and for that you have an obligation. But in exchange for that, you're getting the premium, and that's the key. And we are net sellers of premium, so that means that we are basically net sellers of options too. So there are some things in here you really need to know. Now, in terms of, when you get near the end or at expiration, if you start understanding what usually happens is that most people will cash out of the option. And that's what we're going to do most of the time. And most of the time, we'll be cashing out well before expiration, so we never have to worry about this, except for in some edge cases, maybe 95% of the time, we're cashing out well before expiration, and there's no problem. But there are going to be those times when we want to hold it right into expiration, and you have to know, what that's going to entail. Now, I'm not going to go into it in great detail here, but it'll all be explained in the document. There's more important things to know. All right. We'll go on to now. Here's a graph showing a risk chart, and we'll see a lot of different types of risk charts. These are the two basic option types. There's the call and the put, and then all other options are some combination of calls and puts, either long or short. All right, and when you put them together, you can create these different strategies. But knowing these two types and at least how you read a risk graph is quite important. And I'm assuming that most of you have at least the basic knowledge of what options are about. If you don't, then I will provide plenty of links and resources where you can learn more about it. But the fact of the matter is, most of the stuff that we're going to do is going to be dead simple. And it's all going to be laid out for you. The patterns and the strategies are point and click in both the Doe platform and Thinkorswim, as well as most other platforms too. There's just some little nuances that we'll be using that once you'll pick these up in the course, and you'll be all set. So really, don't worry about it. Now, the risk chart on the call, you can see that the blue line represents the theoretical profit line on price. The x-axis is price. Okay, and then the y-axis is profit, and the horizontal line there represents the dividing line between profit and loss. All right, and the blue line represents the theoretical risk line, where that option is, the divider between profit and loss. So depending on where you are on price, and then the little vertical line that you see there, that's where the strike price is on the call. And for the put, obviously, it's the exact opposite. So you can see from the call point of view, when you have limited risk and unlimited profit potential, and the same way with the put. You have, now this is if you buy, you have limited risk and unlimited potential. Well, with a put, you don't necessarily have unlimited potential, because with a put, you're betting that the price is going to go down. Now, stock theoretically could go up infinitely, but that's not necessarily true. So that's why a call has unlimited profit potential. Now, a put, I guess you could say it also has unlimited profit potential, but it really doesn't, because the stock can really only go down to zero. So that's the limits. But for all practical purposes, you're not going to have to worry about that with Apple. It's not going to zero, at least not in any time soon. So it's kind of an academic argument. All right, so let's go on to a closer look at the risk chart for a call. And you can see that there's the strike price where it crosses the zero line for profit and loss. And I'm pointing out where the max loss is, where you have your defined risk. Now, that's an important part. Now, a call and a put have defined risk, and that's the cool part. They have almost unlimited profit potential, but very well-defined risk to them. So that is part of why options are so great, because they give you this way to create these really either very simple or very elaborate risk profiles, so that you can really create some very, very sophisticated strategies that really will limit your losses and give you a lot more. It will basically gives you your edge. It gives you the edge to make a lot more than you can lose. So, and that's really going to be the basis of a lot of the stuff that we learn. All right. Now, another part of options that we're going to be dealing with a great deal are the Greeks. Now, these are all part of the model that I talked about before in the previous segment, where options have this mathematical model behind them, and there's a lot of different factors that go into figuring out the premium on an option. And we use these various Greeks, these factors that are all part of this model to gauge where we are in terms of the viability of an option. Is our portfolio very bullish or is it bearish? And basically that's where we use these Greeks, not just for the individual options, but when we're looking at our entire portfolio, we look at these Greeks, these numbers. It's kind of like a dashboard, and we see is our portfolio slanted towards a bullish bent, or is it more slanted towards a bearish bent? And what we're really trying to do is try to keep it somewhere close to the middle, kind of neutral. And then we become more collectors of the premium. And that's what theta is. So delta is that thing that gives you that more bullish or bearish bent. If you have a positive delta, then you're more bullish. If you have a negative delta, then you're more bearish. And gamma is the rate at which you're approaching the bullish or bearish thing. A lot of people don't really use it that much, but it'll be important in a lot of the stuff that we look at. We try to keep that under control. And theta is the rate at which we're actually collecting premium. So in general, we're trying to keep our portfolio delta neutral, meaning as close to zero as possible, and theta rich, make our theta as big as possible. So we try to have very little effect in terms of whether something's going to be bullish or bearish. So whether the market goes way up or way down, our portfolio shouldn't be affected. And then by having a large theta, that means that we're collecting money. So here, we don't care if the stocks go up, go down, and we just keep on collecting money. And that's kind of like where the income stuff comes in, and we start talking about all the, the premium collection. Now, Vega is a very interesting one, and we'll talk about that a great deal in future videos. But the amount of Vega that you have on there will tell you how sensitive your portfolio is to changes in volatility. All right, and in a lot of cases with the type of high theta positions that we put on, it's going to have a lot of Vega. So we will have a fair amount of sensitivity, but we can keep that in check as much as possible. All right, so that's the Greeks. And as I said, all this stuff is going to be gone over in great detail. All right, so now we have one of the possible the possible strategies that we can create called the straddle. And really the only reason why I'm showing you this is that there's a concept when we start talking about probabilities. And, what's the probability of the stock going up or down or wherever it's going to go? I use a straddle as a general way to figure out what is the expected move that's going to happen, say, tomorrow or the next week or the next month. Now, that's all built into the implied volatility. But with a straddle really is a pictorial representation of where the market believes the expected move could possibly be on the next period of time. So, for instance, if you wanted to know what the expected move of a particular stock is going to be the next day, you would do an at-the-money straddle. Okay, you'd buy an at-the-money straddle with the weekly. That would give you the most up-to-date view of where the market thinks that stock is going to go the following day. And this is going to be really really important when we put on trades, like for instance in earnings, right? Because when the market is coming up to earnings, you can use the straddle to figure out, well, what is the expected move that the market thinks that the possibilities of earnings could produce. And usually the market is right. It's very, I'd say probably 80% of the time. So you can be pretty darn sure that the movement is going to be somewhere inside that straddle. The other places that we can use straddles is a strategy that we talked about in the previous segment called the squeeze play. Remember I said that we don't know after a squeeze, you know, how much the stock is going to move. We just know that after the squeeze, it's going to move sharply. Well, you would, and it's probably going to move outside the expected move. See, it's all kind of tying together now. So now we can use a straddle in that case. Now a straddle has unlimited upside. It doesn't matter if it goes up or down as long as it moves a lot and goes beyond the expected move. Well, when we have a squeeze play, that's what we're expecting. We're expecting something that goes beyond the expected move. All right, so kind of tying this all together. Hope you're seeing how we're weaving this together. And I'm going to just go over a couple of other risk graphs that we'll be seeing over and over and over again. This is the vertical spread. This is where you go long and short an option. Maybe of different strikes, and so that you have limited downside but also limited upside. And this is just a way of getting a better return on your capital for the type of probabilities that you're setting up to. So it's a very, it's one of those trades that we're going to be using a lot, and it's kind of like the foundation of many of the other trades that are used for theta collection, like the iron condor, which is nothing but two spreads on either side. So when you combine the two, you get this kind of this thing we call the iron condor. And I don't know where all these names came. I'm pretty sure a lot of these names were made up by the Thinkorswim team when Tom Preston and Tom Snoznoff, the founders of Thinkorswim, they came up with these and they added them into the Thinkorswim platform, which is really kind of like the de facto standard platform for most option traders around the world. And so they put these names in there and they stuck. And now everybody calls these things by whatever name that they chose to call these things. So that's kind of a cool little interesting fact. So an iron condor is one of our bread and butter theta collection tools. And what you're seeing here, these the yellow, the red, and the purple line. Well, the blue line, like I said, is the theoretical profit or profit line, where where everything kind of sets, where our risk is the flat area on the bottom, and then above the zero line is where you could potentially profit. So if price stays somewhere inside of that tent there, then we're going to be profitable. Now, what I'm showing with the yellow and the red and the purple line is maybe successive days where that's before we actually reach that theoretical maximum, which is the thick blue line. The thick blue line is what will happen at expiration. When and that's exactly wherever the price is, that's where the profit will lie at expiration. But anything before expiration, you have kind of like this profit bubble that keeps on building and building and then filling and then getting closer and closer to the shape of that blue line. And that's what I'm trying to pictorially show here. And interestingly, when we do our theta collection or our premium collection stuff, that's what we're going to be watching. We're going to be watching, these types of strategies that have these big tents, and we're going to be watching that profit line grow and grow and grow. And as long as we can keep, well, we can't really keep price in there, but as long as price stays inside of that profit tent, we're going to make money. And we can and we're choosing these strategies based on probabilities. So we're choosing strategies that have about an 75-80% chance of probability. So we're making them wide enough so that they stay within the expected move. See, it's all kind of tying together. And as long as we choose things that are fairly confident with within the realm of possibilities and probabilities, that it will remain within that expected move and inside of that profit area sometime by expiration. Now we have some rules around when we actually take our profits. We're kind of aggressive in terms of taking profits. We don't always let things go towards expiration, by the way. So that's one of the things that even improves our profitability even more. So we usually are pretty aggressive. Once we've got some profit in there, usually somewhere between 25 and 50% of the maximum, we're out of there. All right. And then and again, this is a defined risk trade, and that's because it's flat on the bottom, just like the put and the call and the vertical spread. There's a limit to how much you can lose. However, with here's another strategy that's very similar to the iron condor in terms of its profit tent, but it doesn't have those feet. And this is what we call an undefined risk trade. Now, with an undefined risk trade, it's not, and I mentioned this in the previous video, an undefined risk trade like this or like a naked put, it has a lot more risk associated with it, but we can still get that, down to a fairly manageable range or expected move. And this is more appropriate for much larger accounts. Now, the advantage is because you're willing to take on that larger risk potential, the amount of profit that's from the zero line to the maximum profit there is much larger than, say, the iron condor. So if you have a larger account, these make more sense, and it gives you many more options to put on different types of strategies. So there you go. That's what I was trying to accomplish. Just give you an overview of what options are. They're contracts that between buyers and sellers, gives the buyers certain rights and sellers obligation to fulfill those rights. There are some gotchas that you have to be very careful of when you get to expiration, things like assignment, and then I wanted to go over the various types of options and what they are and the risk graph so that you could see all that and kind of tie it all together with the strategies that we talked about before.